Questions are mostly going to be from these three areas. One question that is often asked is, what were the main objectives of Basel 1? What were the main objectives? They are no more in use, but you need to know what were the guidelines in Basel 1. The primary focus was on credit risk. Okay, now we deal with other kinds of risk, but in Basel 1, the primary focus was on credit risk. The asset classification was initially, or rather for the first time, was done based on the risk. Okay, so that was also part of the Basel 1. Banks that operate internationally are required to maintain 8% of the risk weighted assets. Okay, so that was also one of the norms. There are other norms also, but these are some of the few important things that you can discuss in the interview if someone asks about the objectives of the Basel 1. So what are the main objectives in Basel 2? Okay, so capital allocation is risk sensitive. That was something that was recognized. Okay, and recognized in a much more detailed way than Basel 1. It also emphasized on enhancing disclosure requirements, something that was missing out on Basel 1. It also tried to ensure that risk is quantified using data, something that was also missing Basel 1, where use of data in terms of quantifying risk wasn't given that much of importance in Basel 1, and it was updated or rather emphasized more in Basel 2. It also ensured that everything aligned with economic and regulatory capital more closely. So what are the three pillars of Basel 2, which incorporates whatever we discussed in the last? So it has got three pillars. The first one is minimum capital requirements, wherein banks have to maintain capital for the three pillars of risk, namely credit risk, market risk, and operational risk. So banks have to maintain minimum capital for this three pillars of risk. Second one was supervisor review. The third one was market discipline, wherein banks have to disclose requirements to allow market participants, and there are several market participants, investors, for instance, to judge the capital adequacy of an institution. That was also one of the three pillars, which is the market discipline, supervisor review, and minimum capital requirement. So you can include what we discussed in the last two slides if someone asks about what are the features of Basel 2 in an interview. What is capital adequacy ratio? So to keep it brief, the answer is a ratio of banks' capital to its risk. So that's the most basic answer, or pretty layman answers to give an answer what is capital adequacy ratio. Or in a little more technical term, it is the percentage of banks' risk-weighted assets (RWA) to the credit exposure. Okay? So that's basically how you calculate the capital adequacy ratio. So what are Tier 1 and Tier 2 capital? The Tier 1 capital is the main asset of the bank. The main asset of the bank, which include the shareholders' equity and the disclosed reserves. What is Tier 2? It consists of undisclosed reserves. Tier 1 include disclosed reserves. Here it includes mainly undisclosed reserves and supplementary capital other than what is disclosed officially. So there is some capital, not much though, that is not disclosed by the bank, and that's come under Tier 2 capital. What are the features of Basel 3? Basel 1 and Basel 2 we discussed. How do we explain the features of Basel 3 and how are they different from Basel 1 and 2? The minimum common equity tiers are to be maintained by that it takes from Basel 2 as well. The Tier 1 capital increased from 4% in Basel 2 to 6% in Basel 3. So that was an enhancement from a lower percent to higher percent of Tier 1 capital, a compulsory capital to be maintained by banks. To maintain leverage ratio of 3%. Okay, and what is leverage ratio? It's basically the ratio of Tier 1 capital to the total exposure. So that has to be maintained at 3%. And there were introduction of LCR NSER. We will discuss in a little more detail in the next few slides. They are also introduced. So that's basically giving importance to what is known as liquidity risk, something that wasn't discussed in Basel 2. Okay, so we were only concerned about three types of risk: credit, market, and operational. But there is separately in Basel 3 separately liquidity risk were given more emphasis, especially post recession. So what is an A-IRB method? I'm sure if you are working in Basel, these are pretty trivial questions. Already you are familiar with risk management. These are very simple questions, but you can always brush up your fundamentals before going for interviews where people might ask you some of the very simple questions, and you may not be able to answer unless you have just brushed through the fundamentals, before the interview. So these are basically advanced internal rating based approach laid out by the regulators, which is Basel in this case. So banks are allowed to develop their own empirical models. These were not the, in the initial Basel regulations, banks were not allowed to build their own empirical models, but later on they were allowed, and that come under what is known as A-IRB. Banks develop credit risk models such as PD, LGD, EED models on their own instead of relying on the direct percentage or the estimates from the regulators, which are more deterministic or taken directly from the industry benchmark rather than banks' own data and observations. These are then used for computing the risk-weighted asset. Instead of bank directly giving these, regulators directly giving numbers to compute the risk-weighted assets, banks can now develop their own models. That's what. How does IFRS 9 of late is affecting the credit loss modeling? Very important question often asked nowadays is because IFRS 9 is coming into picture in most of the credit loss modeling. Well, initially provisions were based on actual loss. Expected loss. Really sorry, actual loss. Okay, but now it incorporates the expected loss. Okay, so instead of just actual loss, it now incorporates the expected loss. So IFRS 9 requires the credit risk models to calculate 12-month expected credit loss, and this is important, and lifetime expected credit losses. Okay, so how does that affect the credit risk modeling? We will discuss that in another question. Okay, but this is at a much broader level, that expected loss is coming into picture instead of the actual loss that used to happen before implementation of IFRS 9. Okay, so what is CCAR? If you are working with risk regulations in the US, I'm sure you must be familiar with what CCAR is, right? These are CCAR and DFAST are basically post-crisis regulatory frameworks that framework by the Federal Reserve, right? It stands for Comprehensive Capital Assessment and Review. It's a framework to supervise bank holding companies. Now you can check the definition of bank holding companies. It has a benchmark on the asset under management, and one that meets that benchmark will be called as a bank holding companies. So any bank holding company, if someone fall in that category, will be under CCAR regulations. So it ensures that bank possesses adequate capital. Capital structure is stable given various stress scenario. That it ensures. Okay, so CCAR regulation ensures that these are capital structure is stable given the various stress scenarios that a bank is likely to face in future. So it basically lays out the baseline adverse and severely adverse stress scenario to the banks and allow the bank to perform this stress test to be able to be ready for the future. Okay, and just to quantify the risk involved in such adverse and severely adverse scenarios. What is PPNR? Pre-provisioning net reserve. It mainly deals with the forecasting of balance sheet or the profit and loss. It's more rigorous than before. There was balance sheet modeling before PPNR, but Federal Reserve came back with much more rigorous approach than what was available previously. There's more data, there's wider macro data, and that's what is important. The model covers far beyond traditional LM modeling. Okay? Often one question that is asked is, how is PPNR different from the traditional LM modeling? Okay? So you can do more research about how they're different. What is ILAAP? The ILAAP rules requires firms to identify, measure, manage, and monitor liquidity and funding risk across different time horizons and stress scenarios consistent with the risk appetite established by the firm's management. Okay, so the takeaway point from this definition is that ILAAP deals with liquidity. Okay, it deals with the liquidity risk and funding risk. So what are the features of IFRS 9? Okay, obviously IFRS 9 is an accounting regulation, but as a credit risk modeler, you also need to know the basics of IFRS 9, and oftentimes this question also is asked in interviews. So as I've already said, the provision is based on expected loss instead of actual loss. 12-month expected credit losses and lifetime expected credit losses, and then asset is classified at initial recognition and may be reclassified later. Okay, so this is important. Previously, before IFRS 9 was in picture, you would do everything at the time of origination, and I mean, the financial asset that was under consideration used to be valued, whether it in terms of its price or in terms of the risk associated with the asset at the time of origination, or what we call as initial recognition, and that's the way it was categorized into different financial asset categories. But IFRS 9 brings this regulation that it can well be reclassified later based on the risk and the different scenarios. Okay, so risk and scenarios could change over time, so classification would also have to keep that into, or take that into consideration. What are the objectives of building a credit rating model? Okay, simple questions, straightforward answers. So default probability, calculation of default probability for RW calculations and ERC, economic risk capital calculations. Reporting firms' credit positions to senior management, it helps. And of course, credit lending. How do we calculate regulatory capital? Okay, the formula is in front of you. Okay, so these are some of the short names. I'll just read out the full names of this. WCDR is the worst case default rate. MA is the maturity adjustment. DEAD is the downturn exposure or default. DLGD is the downturn loss given default. You put all of these on the formula, and you get the regulatory capital. So what is combined risk weighted asset? Okay, so it basically combines the risk weighted asset for each type of risks, such as credit risk, market risk, and operational risk. So it's just a simple addition, okay, of the risk weighted asset associated with each types of risk. What are LCR and NSFR? We have already discussed in brief, slightly more in detail. During the recent financial crisis, banks went out of liquidity because of their over-reliance on short-term wholesale funding from the interbank lending market, and that's the reason why in the Basel III, regulators wanted these two ratios to be reported to them. Okay, and what these ratios do is it ensures that banks have enough liquidity, okay, to withstand any short-term liquidity stress. So NSFR is basically available amount of stable funding divided by the required amount of stable funding. Okay, so how much money is available to what is required, as simple as that. LCR, on the other hand, is the high quality liquidity assets divided by the total net cash flows in next 30 days period, and the mandatory number for NSFR is 70%. It has to be greater than 70%. What is the difference between expected loss and unexpected loss? Expected loss is nothing but the average loss a bank expects for a given financial year, something that it can calculate very easily. Unexpected loss, on the other hand, is the loss that exceeds the expected loss. You can directly calculate it. Unexpected loss is just the value at risk, and take the expected loss out of it, you'll get the unexpected loss. Okay, we have discussed about IFRS 9, but how does IFRS 9 actually impact the model development, credit risk model development, in particular PD, LGD, EAD model development? Okay, often is a very important question asked in the interviews. So it emphasizes on developing PD models based on the point in time estimate, rather than the through the cycle. Okay, why? Because point in time estimation process takes into consideration take into consideration the changing economic cycle, something that TTC through the cycle doesn't take. In the A-IRB modeling framework, it is assumed that PD scores are used while pricing loans at the origination. Okay, while in IFRS 9, the PD scores could change over time. Okay, something would remain stagnant or something would not change ever based on the A-IRB method. But in IFRS 9, it could change over time. Hence the pricing could also change, and all that have to be taken into consideration while building models. What are the different features of CCAR? We have discussed these questions. Obviously, the straightforward answers: BHC, bank holding companies, have to possess adequate capital. Capital structure is stable given various stress scenarios. Capital distribution such as dividend payout, share purchases, are acceptable in relation to regulatory minimum capital required. What's the main difference between a wholesale and a retail banking? Very easy questions, but often ask these questions because the models are built differently for retail banking and wholesale banking. There are banks who work uh, primarily on retail banking and very less on wholesale banking, and there are banks that have the primary portfolio could be wholesale banking and very little retail banking, but most of the banks work in both areas, right? So one need to be very clear what's the difference. Wholesale banking refers to the service between merchant bank and the institutions. So serving institution is something that's dealt by the wholesale banking, whereas retail banking refers to banking with individual customers, not the institutions, and very small institutions, maybe smaller institutions and individual customers. Okay, now we'll discuss econometrics questions and statistical modeling questions. Okay, very simple ones, but often we overlook them and we sometimes do not know the answer perfectly in the interviews. How do we test multicollinearity? This is often a question asked in regression modeling. We check the variance inflation factor, and then we ensure that it doesn't go beyond the benchmark. If you ignore that, then betas will be biased, and then with biased estimates you cannot go ahead with building a model. How do we deal with autocorrelation? Well, the first way to check the first how do whether autocorrelation is present in your regression is to do a statistical test known as Durbin-Watson test. One way to get rid of autocorrelation is to take the first difference. How do you deal with heteroskedasticity? Firstly, you need to do some manual checks like plotting the error. You can get to know whether there is presence of heteroskedasticity or not. Bruce-Pagan test, that's a statistical test you can perform in order to be able to know whether there is presence of heteroskedasticity or not. So what are the remedies? Take the box cost transformation that makes the variable normal. Okay, so that one way of doing that, using WLS instead of OLS, weighted least square instead of ordinary least square. What are the metrics used for model monitoring? ROC, AOC, receiver operating characteristics, area under curve, Gini, Kolmogorov's mirror statistics, root mean square, error, accuracy, sensitivity, specificity, PSI report, and so on. So you can dig more into them. We'll discuss more about these in the next video, where we're going to have more advanced questions on statistical modeling, but these are some of the major metrics used for monitoring. What are the aspects of model risk? Model risk involve basically model theory, model building, model validation, model implementation, backtesting, and monitoring. Model risk management, popularly known as the MRM, deals with all of these. Okay, and what is the reason behind even worrying about model risk? Okay, so model risk is basically understanding whether the model has been built properly. There could be n reasons why a model could have been built in a wrong way. Okay, there could be many reasons, right? And hundreds of them, and a wrong model can be very hazardous, and that's important to be really made sure. So error can happen from design through implementation. It could have been built incorrectly. All that have to be checked and reviewed. What are the different guidelines for model development? There should be clear statement of purpose. Model theory should be supported by literature, academic literature or industrial literature, or literature from the regulators. All techniques used in the modeling should be explained at great detail with their limitations. This is important. All the people explain the good things about the techniques. People do not include the limitations, but that's also important. Rigorous assessment of data quality. Data should be representative of the portfolio. If you're working with sample data, make sure that it represents the portfolio, the population. Model testing is important, checking models accuracy, checking if the model is robust enough and stable, assessing the model limitations, evaluating models results over a range of inputs. All these things have to be carried out while building a model. Also, what is important is identifying situations where model is unreliable. So what are the different guidelines related to model testing? So you need to see whether the nature of the testing depends on the type of model and the context. So all that have to be have to be taken into consideration. Various statistical tests should be used instead of just a single test. Okay, so multiple statistical tests should be used instead of a single one for the same purpose. Testing model performance over time and scenarios. Okay, like out time validations and out sample validation. If you have ever built a model, you might have heard about all these things. Applying conservative approach, that's also important. What are the different aspects of model validations? So these are the points to keep in mind. Validation should be independent of development. Hence, the development team should be different from the validation team. The development team cannot validate the models. There has to be an independent team that will challenge the model developer. So challenge developer when needed. Models should be rejected if the deficiency cannot be addressed very strictly. Validations during the period of extreme financial and economic situations is important. Okay, so it is not the business as usual situation that's to be considered. The extreme scenarios, financial or economic situations, should also be taken into consideration while building a model. Model validation should incorporate changes in products. Okay, what if a new product is introduced in future, whether the model is going to be good enough for the new product or not. Validation should be periodic, annually, half yearly, or so on. More frequently the better, but obviously depending on the budget and the regulatory requirements and so on. Model performance threshold and benchmark analysis should be part of the validation. Okay, validation involves a number of tasks like evaluation of conceptual soundness, okay, the theory behind building a model, or the tools and techniques used, ongoing monitoring and benchmarking, outcome analysis, and backtesting and so on. So validation involves the three major steps. We'll discuss more about these three steps in detail. So what are the different guidelines related to conceptual soundness? Validation should confirm if a model has been verified with published research. This is important. Okay, so you cannot simply refer to some blogs and build a model based on that. It has to be a peer-reviewed journal. I mean, a research should have been published in a peer-reviewed journal, or a respected journal, or maybe a working paper from some of the top universities, or maybe a working paper from the regulators like Basel or Federal Reserve, or such credible agencies. Sensitivity analysis: how is the model going to behave when there is small changes in the model parameters, and how does it make difference to the output? A small change could make a lot of difference to the model output. If that's what is happening, then the model is large changes to the output due to small change in the output is a sign of unstable model, and hence it should be made stable. That's a bad model. Checking robustness of the model by varying model input values and extremes. Stress testing and sensitivity test analysis should be reviewed by management, and if it indicates it may be inaccurate, unstable in certain situations, then model should be modified. If you think that the model is not performing well, or a model is not model is unstable in certain situations, and it cannot be changed, then in that case there should be complete rebuild of the model. Qualitative information, mostly from the experts from the business, should also be given due importance while evaluating the model. Ongoing monitoring. So it has many components. It starts with model, knowing whether the model is implemented properly for use. So model implementation is very important. The model has been built properly, but if it's not implemented properly by the mostly by the IT folks, then it's of no use, because then the output that comes out of the model is basically wrong. Model component should perform as designed. Code that implements the model should be tested rigorously. Okay, so both unit testing and integration testing of the code should be done very rigorously. Sensitivity analysis and checks of the robustness should be performed in monitoring. Overrides, important thing. If the business is overriding, that means it taking decisions ignoring the output from the model, then all that have to be analyzed. If that's happening more often, then something wrong with the model, or maybe the model is not able to meet the requirements of the business. And then you will also have to see the regulatory side and discuss all three and see what is going to be the best for the overall different situations. Benchmark analysis, another important aspect of ongoing monitoring, that should be done on a regular basis. So benchmark analysis could involve certain external benchmarking, internal as well. Sometimes you have models built previously or models built for other similar portfolio. Then comparison is always going to give you an indication whether the model is performing good enough or well enough or not. Outcome analysis, so it's basically comparison of the model output to the actual outcome. Okay, the model has been built and implemented. Now it's time to see whether the output that comes out of the model is actually similar to what was expected. Okay, so the actual output is now compared with the model output. So it can be done in many ways. The most important ways to do it is doing statistical test and to do expert judgment analysis. So this is more quantitative, this is more qualitative. Backtesting is used for this comparison of actual outcomes with model forecast during the sample time period not used in the model. For example, if you build a model for time period 1, you get the result in time period 2, you compare the outcome 1 with outcome 2 and see how are they different. If they are significantly different, something wrong in the model, and then you have to go back and see. Maybe sometimes you have to recalibrate the model. Okay, what is backtesting? We discussed about backtesting, but you could be asked questions to explain backtesting more in detail. So it's one of the way to do outcome analysis, as we discussed in the previous slide. Example could be, you have evaluated risk model in implementation, and the actual loss is compared with the model forecast loss. Okay, the actual loss you have received from the, let's say, the trading flows, and then you have the expected losses from the VAR model. Do a comparison, do a statistical test whether they're similar or they're significantly different, and then you can come back with an analysis saying that the model is performing as expected or not. It can be done at single point in time, one point in time, multiple point in times as well. Okay, so the result of backtesting is that there could be signs, right? Green means everything is working fine, excellent. Amber, okay, where it is okay, but there are issues, okay, but it's still okay to go ahead with use. But there could be also red signs where you see that the model is not performing at all, and in that situation it has to be recalibrated and sometimes rebuilt from scratch. For vendor models where the banks has no control over, backtesting is very difficult, right? Because you do not know the model itself, you do not have access to the code and everything. So backtesting is only means of validating whether there is no access to code. Okay, so that's what. Okay, one question that could be asked is what are the different aspects of model audit, right? I'm sure you might have heard about what is model audit. If you're already working in risk management, that's becoming very popular nowadays. Okay, so the features are, or the different aspects of model audit are as follows. To audit if the MRN, the model risk management team, is effective and rigorous. Okay, so this is basically, so MRM actually are basically the review teams. So this is basically reviewing the work of the review team. Okay, that's interesting, but that's important, and that that's given due importance nowadays by the regulators. Again, like validation and development teams should be independent. Similarly, validation and audit staffs should also be independent. Audit should properly evaluate models, validation and backtesting. Like validators or MRM people, they actually validate the work of model developers. Model auditors, they evaluate the work of model validators and backtesters. So how do we perform backtesting? You know, there are a few ways. There are a few metrics used in order to see whether the actual is similar to what was expected. One is to see the stability. Okay, stability of the population, whether the population has changed over time or not. When you do backtesting from, for the current period, wherein you are trying to compare it with some the model development period or period well in past, you see whether the population has changed over time, and you use what is known as a population stability index or PSI to see whether there is a significant difference. We have a question on PSI, so we will see how PSI is calculated later on in this video. Discriminant power to test if the model is able to discriminate good and bad in the case of, let's say, PD and LGD. PD and in LGD and EAD, of course, there are ways to see whether it is performing as expected or not. So we use AUC power stat to see whether the discriminant ability of the model is good enough. Predictive power, comparing actual versus the observed. The statistical tip that's used is the binomial test. Okay, that's used to see whether they are similar or dissimilar. So what is stress testing? Often you will be asked questions about stress testing and so on. So the idea behind stress testing is to study the impact of abnormal markets and its impact. Okay, if there is abnormal situations, how the situations are going to impact the model and its output. Determining spread over risk-free rate. So that's another reason why you go in for stress testing. Risk-free rate obviously is much less, so you place a risk premium for that. So it also helps in terms of pricing. Okay, to know what are the extra stress that's involved with this particular financial asset, given the situations that could come in the future, and based on that you see the credit spread. Regulatory requirement, it's always a regulatory requirement to provide stress testing reports. In fact, CCAR, DFAST are basically stress testing framework for the bank to conduct on a regular basis. What are the different types of stress testing methods? Few types I'll discuss. Sensitivity test to see impacts of the change in the variables. Variables as in the variables used in the model. Okay, for instance, the income of an individual, or the credit score of the individual, and so on, but doesn't take into consideration the macroeconomic information. Okay, it is only the variables related to the individuals or an institutions, not the macro variables, inflation, interest rate, unemployment, and so on. Scenario test to see impact of portfolio um, based on events. Okay, so what if this event happens, and what will happen if that event happens? Okay, so that's come under what is known as scenario testing. Scenario testing could be two types: historical scenario testing, wherein you are taking only the situations or scenarios from history or things that have occurred in past. So taking only historical scenario is what is taken in historical stress testing. Hypothetical stress testing is another way of doing scenario testing, wherein you are taking scenario that have not yet happened, and that's the reason why we're calling them as hypothetical, something that have never been realized but could well happen, although the probability or the chances are very small, but yet you cannot rule out. What are the challenges faced in stress testing? Few I'll discuss. Adhering to regulatory guidelines. Sometimes guidelines are so strict. One practical issue that people face is that while market stress testing happens every day, credit risk, it happens much less frequently, or it could happen quarterly or happily or annually. So when you integrate across different risk types, you face this challenge, that how do you integrate the stress testing results from the market risk for market risk and with that of the credit risk. That's a big challenge. Deciding on the reporting line, frequency of the test are also some of the other challenges that you might face while doing stress test. Okay, so question is, another question that could be asked is, how is periodic model validation occurs? What's the reason? To be sure that the model has good predictive power, variables in use should remain good predictors. Okay, model should be accurate and robust. Okay, okay. So when you're answering questions related to model validations or stress testing or back testing and so on, the initial answer should be crisp and to the point. And the next, obviously you will expect questions, supplementary questions, and then you go into details of how these are being done, and we'll discuss about the tools and techniques used. We'll continue with some of the validation points. Banks must measure the model performance. Banks must regularly compare the realized default rate and the estimated PDs, external data, model benchmarking, MRM, and so on. So all these points can be included in your answer. We discuss some of the key validation principles. Okay, there are quite a number of, we have already discussed quite a few, but if in case you are asked this question directly, you can simply use these points from the slide. You can write it down and you can talk about it in the interview. Validation is about assessing the predictive ability of banks' risk estimates. The bank has the primary responsibility of validation. Validation is an iterative process. Important, right? It's not a one-off process. It's not a science, so to say. It's a combination of science and art, where you can actually impress regulators by being very thorough with the different iterations and making sure that the final report is robust enough. There is no single validation process. There are multiple ones. You need to select the one that suits the situation, the portfolio, the product, and so on. Validation should include both quantitative and qualitative elements. Important is to be part of the validation process. The principle of backtesting. What are the different principle of backtesting? Data stability, whether the population has changed or not. Okay, that's the reason why people do backtesting. How will the PD rating system provides an ordinal ranking if the risk measures considered? Okay, so these are some of the little more technical way of answering questions. We have discussed in much more layman way in the previous question, but this is slightly more technical, where we are talking about the ordinal ranking of the PD model, something that's used. Mapping of the risk rating PD or calibration is good if there is only marginal deviation from what was initially there at the time of development. So if the ranking is very similar, perfect, no worries. If it is slightly deviating, fine, still okay, but under supervision or monitoring. But if it is significantly different, then there is issue. Backtesting involves calibration, discrimination, and stability. Okay, we have discussed about PSI, but we didn't discuss about how it's calculated, right? So population study visitor index is as an important part of backtesting in credit risk modeling. So how do you calculate? This is the formula. Okay, so what you basically do is that you you convert the population data that you have for the current period and that was used for the development period, or it could be any two periods, may not be just current or development, it could also be other periods, and then you create deciles. Okay, there will be 10 segments, right? When you create okay, and then you calculate the actual percentage and the expected percentage, okay, of events. Okay, and then you multiply that with the ln of that, just for normalization purpose, and see the difference. Okay, and you will get a score. If it is greater than 0.25, then there is a large shift in the population. If it lies between 0.1 and 0.25, then there's a moderate shift, and it's still okay, but it has to be monitored properly. If it is less than 0.1, then there is no significant shift. You can go ahead with the use. So how do you measure the discriminative power? Many ways. You can use a number of metrics: Gini, ROC, AUC, case, accuracy, and so on. In fact, nowadays with most proprietary softwares will obviously give these directly. If you are using open source ones, then you have to write your own code to find PSI or AUC or KS values. But that should not be an issue as long as you understand the way this should be computed. Questions could be asked related to testing PD calibration. How do you calibrate a PD? Okay, you do it with using binomial test. Whether it deals with basically with two outcomes. PD obviously deals with mostly two outcomes: default, non-default, or repeat of events, and the events should be independent. These are some of the assumptions, and you can go ahead with binomial test to see the calibration. Okay, normal test, Vasey check, one factor model. These are some of the alternative ways to do it. You can of course think more about normality test and Vasey check test and so on, and see how they are different from binomial test and so on. We'll discuss few more questions related to PD calibration in the next video, which is going to involve more advanced questions. Thank you.